Hello, everybody, and I'd like to welcome you to my new channel on quantitative oil trading. Let me start by saying a few words about myself. I'm a mathematician by training, and I was very fortunate to end up in the oil trading industry among the first quants, probably in the mid-90s. Subsequently, I ran a large-scale trading business for 25 years with a strong quantitative focus. And after 25 years, I retired as a professional trader, and I became an educator. I'm teaching now at NYU and a few other universities, writing for Oxford Energy Institute and several other publications. So my really mission is to connect the industry in academia. There is a fair amount of interesting ideas in academia on oil modeling and trading, but unfortunately, it's not presented in the right language. It's making some incorrect assumptions. So the purpose of this series really to explain how the world really works. And hopefully it helps both in academia to understand the oil market and traders that you guys can use for your own portfolio management. A quick disclaimer, I work for myself. Everything here is for educational purposes only. The future is not equal to the past. All I'm saying really is based on my own experience in managing trading business. I'm not selling anything. Again, the purpose is entirely educational. So I've recently written a book called Virtual Barrels, which basically is based on the lecture notes of my NYU class. So let me today set a stage. Today's first introductory lecture is going to be non-technical. Subsequently, we'll touch more sophisticated quantitative areas. But I'd like to set the stage with something more simple. But it's important to understand really how the oil markets really work. The graph here is showing the financial trading volume versus the physical oil consumption. So we all know that we roughly consume, give or take, about 100 million barrels a day of oil these days. But we trade roughly 6 billion barrels a day, which is 60 times more. About half of that volume trades on ICE, which is what I graphed here. But if you add CME options over the counter, you get to up to 6 billion barrels per day, which is 60 times more than the global oil consumption. Just to put things into perspective, when I started my career, like in mid-90s, that ratio of financial to physical consumption was roughly 1-to-1. Today, it is 60-to-1. So that gets you an idea how important these financial barrels became over the years. The term financial paper barrels is not new. It really existed from 1860s in the first oil exchanges in Pennsylvania and has been used for over 100 years, really. But after 160 years, I thought I would just give it a new life, and I called my book Virtual Barrels because we no longer even write deals on paper. All of this, our oil deals live somewhere in the cloud. So the goal of the book really is to explain what these virtual barrels are. And you see how fast they have been growing, starting from approximately 2005, and they keep growing every year. And that trend will likely continue, and I'll explain in one of the videos why. So let's kind of get going. So because as you could see in the previous slide, the physical trading volumes are so small now relative to financial volumes, you can no longer explain the behavior of oil prices in the traditional manner using fundamentals. So the traditional theory of storage, give or take, basically says that oil prices or future spreads are negatively correlated to inventories. When inventories are low, prices are high. When inventories are high, prices are low. So just to illustrate, I just pulled the weekly changes in oil prices versus weekly changes in US oil inventories over the last couple of years. And you can see that graph is basically a random noise. When I started my career, it wasn't random noise. It was a fairly negatively correlated behavior. In contrast, if you do correlate weekly oil price changes to weekly changes in positions held by hedge funds, you got extremely high correlation. The R squared is about 75. So it actually shows you for roughly 100,000 barrels, 100,000 contracts, sorry, 100,000 contracts buying by hedge funds translate roughly into $4.50 barrel of price. So that relationship is indeed quite strong. So that leads us to a paradigm change on how we should model the oil prices. So instead of directly modeling the impact of supply and demand or inventories or other fundamentals on prices, in today's market, one needs to model the participants' behavior. In other words, one needs to model the agents and how they react to fundamentals, and other factors, macroeconomic factors and technical factors, because ultimately, we all know that folks like OPEC are extremely important to the market, but OPEC doesn't buy and sell futures. OPEC can only control the production. The futures are being bought by traders. So what we need to know, how traders react to OPEC, to macroeconomic factors, to inflation. So it's a reaction function that we need to model. So the idea of modeling agents or participants is not new. It was an alternative to modeling prices as a theory of storage. The alternative was proposed by John Maynard Keynes in 1923 and subsequently in 1930s via so-called the theory of normal backwardation. However, Keynes used that concept for mostly agricultural market because oil markets didn't really exist back then, or oil futures. So the economy, the agricultural markets were a lot simpler back in the days than the oil market are today. So in the traditional old Keynesian framework, there were three main market participants: producers, consumers, and speculators. The idea was that the markets are naturally in disequilibrium, where producers' demand for hedging dominate that of consumers, because producers basically have non-diversified, very highly concentrated risks. So they are much more exposed to the prices of the commodities they produce than consumers. And then John Hicks, by the way, who is a Nobel Prize winner, was also a big proponent of that theory. That's why the theory became known as John Hicks' theory of normal backwardation. So therefore, the markets are in disequilibrium. The futures must trade at a discount relative to the expected spot price. And that was considered to be the fair value. The fair value was measured by the expected spot price, whatever it is. So the idea then, if futures trade at a discount, you need someone else to take the other side of this highly imbalanced futures market. So the speculators are the ones who must be incentivized to come in and essentially buy futures at this perceived discount, which they are supposed to realize over time by simply buying and holding commodity futures. Subsequently, in academia, this term became known as a commodity risk premium. And that was a big factor in the beginning of the financialization, which I explained in a whole lot more detail in the book. The structure of the modern oil market is drastically different, however. The largest market participants are no longer consumers and producers, but rather they are financial traders more on the long side and inventory hedgers on the short side. And again, I will differentiate between true producers and inventory hedgers, and I'll explain shortly why. As a result, we'll see that no structural risk premium really exists, as this hedging disequilibrium does shift more dynamically when financial flows and balances shift and hedging demand shifts. So a lot of quantitative hedge funds are now trying to capture this dynamically changing risk premia via certain quantitative strategies, which we're gonna cover in a lot detail in this series. Another complication in the modern market, in the modern oil market, that unlike many other commodities, hedging and speculations in the oil futures markets is very intertwined. So one can actually look at financial speculators as hedgers because they are hedging their risks of inflation and geopolitical risk in their broader financial portfolio of bonds and stocks. And vice versa, many traditional physical hedgers are also huge oil speculators because they tend to own assets like storage or pipelines. In fact, they often buy assets to leverage their proprietary futures trading. So that's why the lines between speculation and hedging, specifically in the oil market, are very blurred. So as a result of that, unfortunately, a lot of academic research and many oil studies have been fooled by the Commitment of Traders report. The COT report is a primary source of information about the behavior of agents or participants. They have existed in different shapes and forms from 1920s, originally for the agricultural market, and then for oil since 1983, I believe. So the basic idea wasn't so bad. The idea was to split all traders into commercial and non-commercial traders. The commercial traders are then associated with hedgers, and non-commercial traders are associated with speculators. That's an idea. But the oil market turns out to be way too complicated for such a simple categorization. It might have worked for a certain agricultural and metals market, but not for oil, for a number of reasons. The number one probably reason, there is a gigantic over-the-counter market that exists in oil that simply does not exist in many other commodities, sometimes because it's just prohibited by law. But in oil, producers and consumers don't really hedge in the futures market. They hedge over the counter with banks and swap dealers, mostly because they get much better credit terms, and also the structure of the program is somewhat customized. The second reason, as I have already mentioned, the sophisticated non-commercial physical speculators own assets. So from the one hand, they are truly commercial hedgers. And I actually made a typo here. Sophisticated commercial physical speculators own assets. But they also own storage and pipelines. So basically treating them as hedgers is wrong. And finally, the financial investors use oil, as I said, as a hedge against inflation and geopolitical risks. So to shed some light on this really messy categorization between hedgers and speculators, the regulators launched a new report, disaggregated reports, in 2006 for WTI and 2011 for Brent. But unfortunately, it created even more ambiguity because it split commercial into two buckets, PMPU, so-called PMPU, which stands for producer, merchant, processor, and user, and swap dealers. And non-commercials, they split into money managers and other reportables. The first bucket, the producers, it even create more, as I said, ambiguity because it references explicitly to producers. So that's why the researchers tend to associate this category with producers. But as I said, producers are not even there. Producers are hedging via the swap dealer. So all positions essentially held by the hedging position, the true hedging, are being reported by swap dealers. So every time you're trying to analyze the behavior of true hedgers using either PMPU or broader commercial bucket, you're not gonna really get anything. It actually helped a little bit by segregating the speculators into two buckets, and I'll show again in a couple of slides why. So broadly speaking, you can think about money managers as registered hedge fund and other reportables as funds, which basically happen to don't have to be registered. For example, funds that set up outside of US and UK and European jurisdiction, and if they don't have any US European investors, they don't have to register. It doesn't necessarily mean they're small. In fact, there is a fifth category specifically referring to small, which I call mom and pop shops. Their positions are indeed smalls, and we're really going to ignore it. But other reportables are not necessarily small. So as a result, the academic researchers are trying to force to focus on basically on the wrong bucket. And that's why it's not surprising that you can't really get anything by looking at the oil market through the traditional prism of the Keynesian paradigm of hedgers and speculators. You basically get what I call GIGO, garbage in, garbage out, empirical results on hedging pressure. And that's one of the focus of my series to really understand who is who. So today, I'd just like to quickly run you through who is who really in WTI and Brent market, which are the primary two benchmark in the oil space. The PMPU are so-called producers in WTI market. This is a blue line here. So you can see that they're not even short. So I'm recording that video in September of 2025. You can see over the last couple of years, PMPU actually went long. So if you're analyzing the hedging pressure in the Keynesian paradigm, then your conclusion would be that US consumers now dominate producers, which is completely wrong. So what's really happening here, there are two types of hedging flows in WTI market. So one is a traditional, you own oil in a tank somewhere in Cushing or in Gulf Coast, and you sell your futures as a hedge against oil in a tank. That's your short. But at the same time, WTI now is included in the Brent basket in Europe. So, and in fact, it's an important component of price formation in Brent and Europe. A lot of WTI cargoes are now going to Europe. So the two markets became much more integrated. And a significant hedging flow is now hedging this ARB. Whether it's a WTI Brent ARB or the ARB against WTI and Cushing versus Gulf Coast, or even in Canada versus WCS. That ARB, people have long WTI positions against shorts being held elsewhere. So this long WTI sometimes offset even exceeds the inventory shorts. That's why you see the positions held by WTI, so-called producers, don't even have to be short. And on top of that, there is a fair amount of speculation by the same folks who are hedging the ARB or holding inventory in the tank. So that bucket PMPU is really not particularly useful in analyzing the behavior of producer hedging. The bucket which is somewhat useful is the orange line, which represents positions held by swap dealers, mostly banks, but there are some energy companies registered as a swap dealers in the US as well. So you can see that orange line is structurally short, and it's significant short, about 4 to 600,000 contracts, 600 million barrels. This is because in US, essentially consistent with the Keynesian hypothesis, the dealers' books are dominated by producers. US consumers hedge very little. In fact, the US airline industry have been practically unhedged over the last, I would say, half a dozen of years. They used to hedge a bit more in the past, but not anymore. There are obviously bits and pieces of hedging happening by other US consumer, industrial consumers. But by far, it's dominated by short hedging by US and Canadian oil producers. That's why you see that this line is short. And by analyzing the behavior of this line, you can see whether producers are selling more, like in this case, or they're covering some of the shorts. So that's actually an important category to analyze. But again, you should be looking at the swap dealer bucket rather than the PMPU on WTI. And on a speculative side, on a non-commercial side, broadly, you can think about speculators, you can categorize them and put them in three groups. So one would be a hedge fund. Most of them are algorithmic traders, but not all. And at some point, we'll decompose the two. Some of them are fundamental funds as well. Then you get a large growing category of retail traders, especially in the United States, driven by a lot of ETF flow. And then long-only passive investors, such as insurance companies or different so-called risk parity funds. So unfortunately, the positions by the latter category, the first two are a bit more easier to analyze, at least in WTI market. The managed money tend to be associated with professional funds. This is the grain line. And the other tend to be associated more with retail investors. And some of the hedging of ETF flows go into that bucket as well. Both are positive. That means on average, they tend to have to hold long positions in WTI. One of the reasons that they, for example, the managed money tend to have long position on WTI is the third category, the risk parity fund or long-only investors. Because the long-only investors actually hold their position in two different ways. If you're a sophisticated investor, then you would hold your position directly in the futures market, in which case you would be reported in the gray line. However, if you want to outsource your investment to the bank, and instead of holding or managing your risk parity positions in the futures market, you can ask the bank to do that, and you can buy a total return swap on an index, and then essentially the bank dealer would buy futures on your behalf. In that latter category, your futures are being held by the same orange line. So essentially, it's going to be offsetting some of the shorts held by producers, but it's not enough. Producers are still bigger. So that's more or less the layup in a WTI market. Let's move on to Brent, which actually happens to be quite different, even though they're very similar markets in general, but the structure of participants is actually quite different. So let me again start with PMPUs. As I mentioned when I talked about Keynesian hypothesis, the largest shorts in today's oil market are not even producers. They are inventory hedgers. And the inventory hedgers are being reported in a blue line on the PMPU. And they're much bigger and much shorter than they are in WTI market. That's simply because most of the physical barrels that's being transported are being linked, priced, and indexed to the Brent market, not to the WTI. Therefore, all this oil that's currently being in transit, and there is about roughly, give or take, about 1 billion barrels of oil which are being in transit on any day. And most of, if not all of that oil is diligently hedged by selling futures. And that's what you see here in the blue line. So that's very short, structurally short. And you see the numbers can get up to 800 million barrels. And it fluctuates. It fluctuates because, again, there's other hedging and speculative activity is going into that bucket by the same participants. Remember, there is also a second lag from the ARB hedging that I've described in WTI Brent. There is a lot of other things going on into that bucket for sure, but it gives you the net big structural short bias. Also, in contrast to WTI, look at the orange line. That's Brent swap dealers. So the Brent swap dealers are net long. So the swap dealers are basically, unlike the WTI market, are dominated by consumer hedging. So that's an opposite to the Keynesian theory, because in Europe and Asia, a lot of oil production is being owned by the sovereign, and the sovereigns really don't hedge, with the exception probably of Mexico, and we'll cover it in one of the subsequent videos. And vice versa, European and Asian consumers, such as airlines, are fairly active hedgers. So the balance is flipped the other way, and European consumers basically taking the other side of PNPUs. They are the largest long, and PNPUs are the largest shorts. The hedge funds are also a bit different. So the gray line represents the professional traders. And a lot of them are quantitative hedge funds. A lot of them are based in London. They prefer to trade in the global market, like Brent, in contrast to WTI. It's kind of less squeezable in a sense after negative prices that we have seen. There's less funny stuff going on around expiration, and this is global. So that's why they tend to prefer to trade. They prefer to trade in the Brent market. So it's much closer association with algorithmic type of hedge funds. But another interesting thing, the other traders, which is the yellow line, are short. And this is the most mysterious category, because the reporting requirements in Brent are looser than they are in the United States. And because of these looser requirements, they're basically self-designated requirements. A lot of folks basically found a way to self-designate themselves as other. And by looking at the behavior of other, they're actually short. Unlike WTI, where others are dominated by retail traders, some ETF hedging, other in Brent represent a very different crowd. In fact, it's a mysterious crowd, and it's very difficult to verify given the lack of public data and disclosure. But anecdotally, people are basically saying some of the large sovereign funds are being hidden here. And you can see, because the positions are short, many of these entities represent some structural hedging. So it's very easy for some sovereign entity to set up XYZ fund, which doesn't have to be registered. And if you own a lot of, for example, oil in your strategic, not to name any countries, reserve, it's quite easier to actually hedge that if you want by selling futures via this XYZ fund registered outside the US and Europe. But it's a mysterious category, so we'll talk about it at some later stage. But you can see how different the structure of the markets are, the participant structure between WTI and Brent market. So real quick of who is trading against whom here. Basically, on a high level, everybody trades against managed money. So you can see the correlation, and this correlation over the long period since the introduction of decode reports. So you can see that over the long period, the hedge funds are negatively correlated, both in WTI and Brent, pretty much to everybody. In particular, they are negatively correlated to other, which is important because a lot of academic studies use non-commercials to analyze speculation. So if the two components of non-commercial are essentially negatively correlated to each other, then by blending them together, you're losing information. Then you shouldn't be doing this. You should be analyzing them separately. And we have some of the recent papers on that, which are not actually in the book, that's getting into much bigger detail. So you should be analyzing them separately. Then if you look at the correlation to prices, you can see, again, this is over a long period. Managed money, the only positively correlated to price, everybody else is negatively correlated price. And also traders' behavior tends to be persistent. So the last correlation here is autocorrelation, meaning the correlation between weekly position changes this week and the prior week. So most of them are basically, that means what they're going to be doing this week is what they were doing last week for everybody except for other tend to be a bit more erratic. So by looking at all of this, it's basically the easiest takeaway is money managers who manage money tend to be momentum traders, and everybody else trying to buy low and sell high, taking the other side of it. And then the final slide for today, more like a teaser for our subsequent videos. So who's really winning in that game? Again, futures is a zero-sum game. In academia, people tend to look at this speculative or hedging pressure in a bit of a weird way. First of all, they look at returns, investment returns, and the reason they do that because they tend to analyze it across many commodities. They need to standardize it. But in oil, we don't really have returns. The concept of returns in futures trading and the oil trading is really bizarre. So we measure everything in terms of dollar per barrel. We measure our P&L, we measure our risk. So if we want to calculate risk-adjusted P&L or Sharpe ratio, we take P&L divided by risk, also measured in dollar a barrel. So this is a much more accurate measure than using some funny investment returns. And likewise, for the hedging pressure, we're not going to normalize it. We're just going to use raw data on positioning. So because we have both prices and historical raw positioning data, so we can actually calculate who made and who lost money historically since the beginning. So it turns out, if you simply look at commercial and non-commercial, this P&L divided by volatility is basically zero. So it's very small. So here, what I shaded in gray, it's kind of the area of economic insignificance in the eyes of the oil trader. So if you're an economist, you tend to use like a t-statistics or p-value. If you're a trader, you just use a Sharpe ratio. It's much more practical and intuitive. And for us as traders, so the Sharpe ratio below 0.25 are basically noise. It's statistically insignificant. So it turns out if you split commercial, non-commercial into 4 buckets, according to DCOT reports, PMPU, swap dealers, manage money, other, it's still economically insignificant. Yes, you see bits and pieces here, for example, WTI PMPUs making money because, again, they're smart, sophisticated physical traders. Quant's making money in Brent, manage money. Others tend to be loser in both. So retail or hedgers. So, but it's not statistically, not economically significant. So let's dig a little bit deeper. So what we found out recently, the key to identifying winners and losers is to decompose it a little bit more by decompose it by investment horizon. And the most interesting observation came from decomposing the managed money. So what we did, we decompose them into 2 parts, the slow money and fast money. The slow money, we simply represented by the 3 months moving average of their positions. And you can use 6 months, conceptually, it's very similar. So the idea is slow money is the proxy for pension funds, for long-only investors, because remember, there is a net positive bias in the managed money position. So we're trying to capture this bias by using the longer-term moving average. In fact, it's quite correlated to simply long positions. So, and this MM slow also not making or losing any money. And then MF fast would be the residual. It's a residual between the total position and removes the long component out of it. So this MM fast are dynamic quant traders, mostly quants, I'm not saying all quants, dynamic smart traders who basically trying to capture this dynamically changing hedging disequilibrium. So that's my proxy for smart money. And it turns out they're indeed making money. So since the beginning, since I have it for 14 years, both in WTI and Brent, and they're generating about 50% Sharpe ratio, which is not bad because this is an aggregate. All the hedge funds in that category, including the losers. There are losers too. So on aggregate, they're able to generate the positive Sharpe ratio about 50% in both WTI and Brent market, which is particularly impressive because given the structure, a different structure in both markets, they're making money in both. So what do they do? And how do they trade? Well, I mean, that's the subject of my next video. I do hope that you enjoy my first lecture. And if you did, as well, I guess I'm a YouTuber now, so subscribe for my channel, please. And in the next one, we'll explain what they actually do. And again, thank you very much, and I'll see you in my next lecture soon.